There are many tax-efficient solutions out there, but one must always be mindful that it must fit the proper financial plan. Now, we all know that with the budget speech tomorrow, we're going to see tax increases. So there's going to be a knee-jerk reaction and say, where can I get the best tax-efficient investment? And that is not always a good place to start. So if we go back a little bit and say, what is the budget speech all about? Budget speech is about the income side and the expenditure side. They need to balance that. Now, it is very similar for the household. We need to do the same. We need to match our income and our expenditures. So our expenditures could be long-term, short-term, or medium-term, and that's where we start. So if you think of a long-term investment, other investment that you're asking about is, for instance, a retirement annuity. Now, a retirement annuity has changed character quite a lot these last couple of years. Apart from very meaningful tax concessions, it is a perfect vehicle to plan for that expenditure in future. So, for instance, a goal for the future would be to retire, to be financially independent, and very important because the medical tax relief, we'll see what happens tomorrow, or perhaps later years, that is under threat. So you may want to provide for post-medical expenditure. Now, what better investment than a retirement annuity? And why do I say that? Well, with the retirement annuity, you can claim, since the 1st of March 2016, up to 27.5% of your remuneration or taxable income. And there's a limitation of 350,000 Rand. Now, what is the relevance that to the budget speech happening tomorrow? If the marginal rate is going to increase, let's pretend from 45 to 48%. If you would contribute to a retirement annuity, your deduction would be exactly the same than that increase. So let's say the tax brackets are not adjusted for inflation and you're effectively going to pay more tax. If you want to stay on track with your goal, invest into a retirement annuity. And that's why I call a retirement annuity, to a large extent, a tax neutralizer. So it doesn't matter whether tax rates are going up, because you're still going to stay on track. Oh, well, first of all, I think one has to compare that with a retirement annuity. They're not the same thing. And how do we differentiate? The long-term goal, a retirement annuity would be suitable. When you talk about a tax-free investment, then one would rather look at a medium to longer-term goal. Examples would be, I want to save in 10 years' time for the education for my children, or go on a vacation. Now, a tax-free investment, which you can contribute per taxpayer, it used to be 30,000, it went up to 33, maybe it will increase. But per taxpayer in that household is entitled to contribute to a tax-free investment. The difference is that you're not going to get a tax deduction, unlike the retirement annuity. But the proceeds will be tax-free, be it capital gains tax, dividends tax, or income tax. The real beauty is there's no tax in the fund. And compound growth is the real value when it comes to investment. So if you want to achieve that goal, the mere fact of making use of a tax-free investment will assist you to reach that goal a lot quicker, because the compound growth could just be so much more. So a tax-free investment could supplement the retirement, but it does not a question of which one is better from a tax point of view. That is not the issue. And around about 2015, when tax-free investments were introduced into South Africa, the thinking was to take away, and that was 23,800 if you're younger than 65, and over 65 is 34,500. So that is an exemption. So if you would invest into a money market fund and you'll earn interest income, up to a certain amount is exempt. Now, I find it strange if they would increase that, because that was not the intention. And as a matter of fact, it didn't increase the last 5 years. And the thinking was to do away with it, but instead, we're never going to adjust it. So that will eventually just erode with inflation. However, it plays a very useful part. Because if you assume an interest rate of, let's say, around about 6%, you can invest a capital amount of more or less 400,000 before you get to the interest earned of 23,800, which is tax-free. So this is a typical one for an emergency fund. It is the short-term one as opposed to the tax-free investment, which would be more medium to long, and the retirement annuity would be a long-term one. One must not forget, having said that, to pay off your debt is also a very good strategy. But financial planning is not always about the best return, because repaying your debt is like a guaranteed after-tax return that one can very seldom beat in the short term. But financial planning is about setting goals, different horses for different causes, and depending on your goal, that will determine the suitability of whichever product that you're going to choose.